Venezuela holds approximately 303 billion barrels of oil reserves and 200 teracubic feet, TCF, of natural gas. Roughly 80% gas reserves are associated gas, found onshore in the Orinoco and Monagas fields. This is a game-changing endowment. The strategic shift is decisive, from capital-intensive refineries to diluted crude oil blending. By mixing extra heavy crude with lighter diluents, the industry reduces costs dramatically and accelerates production recovery. Commercial viability requires infrastructure integrity. Pipelines, storage, and terminals must meet international standards. This is achievable.
January 2026 marks a historic shift. The new Organic Hydrocarbons Law eliminates the mandatory 60% state equity requirement. International operators, Chevron, Repsol, and others now have full operational control. They manage production, execute direct sales, and secure revenues through international accounts. This is not rhetoric, it is operational reality. Chevron and Petropire have validated the model with 85% upgrader capacity and measurable production gains. The proof is in the numbers. The fiscal regime has been transformed. A 15% integrated hydrocarbon tax replaces the old 33% extraction tax. The ministry can lower the royalty to 1% temporarily. Once the project reaches a certain volume or the investor recovers its initial capex, the royalty gradually rises, staggered, until it reaches 13.33% or 30%, calculated on the market value at the inspection point, wellhead. This compresses the country risk premium and makes Venezuelan assets competitive globally. International arbitration guarantees legal certainty. Capital now flows with confidence.
March 2026. Venezuela aligns with international SPE PRMS standards. Orinoco reserves are officially reclassified. 80 billion barrels are now proved. Use billion instead of million. This standardization unlocks global capital. In Maracaibo, enhanced oil recovery revitalizes mature fields. Offshore, the Dragon field is positioning for 2027 production. Shell and Trinidad are finalizing subsea infrastructure for regional LNG. This diversification de-risks the entire portfolio. Under OFAC licenses 46B and 52, PDVSA is restructuring into strategic clusters. Private operators assume full operational control. Shut-in wells become profitable assets. The landscape is bankable. Venezuela reestablishes itself as a premier strategic energy province.
Restoring the 3 million barrel per day benchmark requires $18 billion over 10 to 15 years. The primary constraint is power. The national grid operates at 34% capacity. Without a $37 billion Guri Dam overhaul, production is capped at 1.2 million barrels daily. The solution is clear. Operators are implementing self-generation. Gas-to-power and solar systems integrate directly into field operations. This bypasses the volatile national grid and ensures operational continuity. Midstream decay is also quantified. 5,000 kilometers of corroded pipeline cause a 15% production loss. While 15% was a widely cited figure during the peak of the infrastructure crisis in 2024 and 2025, recent reports indicate that the national refining network has improved to 31 to 35% of its installed capacity. These are capital priorities, not obstacles. The Lake Maracaibo Verdine crisis, oil slicks and algae blooms from leaking wells, poses ESG challenges. These are managed through strict liability ring fencing. Partners isolate themselves from historical degradation and focus capital on modern asset integrity. A 10 to 15-year recovery horizon is realistic and achievable. The 2026 reform offers 4 development pathways: 100% private operational risk models, enhanced mixed companies, pure private ownership for non-associated gas, and strategic alliances for brownfield reactivation. This menu accelerates project economics. Project bankability has surged. Estimated internal rates of return now reach 18 to 24%. The autonomy factor, offshore escrow accounts, independent marketing rights, international arbitration, de-risks capital completely. Geopolitical stability is anchored by U.S. licenses 46B and 52, issued March 18, 2026. Proceeds are managed through foreign deposit funds in neutral jurisdictions like Qatar. This mechanism prioritizes humanitarian needs while securing compliance-driven capital flow. ESG compliance is mandatory: zero routine flaring by 2030, leak detection and repair programs, baseline audits for legacy liabilities, community development funds financed by gross revenue. These are enforceable requirements, not optional ideals. The framework ensures that Western capital, pension funds, energy majors, infrastructure investors can participate with regulatory certainty.
Under the 2026 reform, upstream contracts target 2 million barrels per day by 2028. This triples export revenues and monetizes flared gas. The economic impact is double-digit GDP growth. This liquidity stabilizes the exchange rate and funds regional energy transitions. The oil sector becomes an anchor for macroeconomic recovery. National production has already stabilized at 1.1 million barrels daily. This validates the joint venture model. Short-cycle brownfield projects are the near-term focus. Rapid ROI is achievable. Venezuela's energy renaissance is not a proposal. It is a structured, capital-backed, operationally validated pathway. The solution is ready. The capital is waiting. The time is now.